Well, hello, everyone, and welcome to another special edition from the Alpine Broadcasting Network. My name is Dan Charlie, and I'm the president of Alpine Brokerage. And today, the topic we're going to talk about is 2021 insurance impacts and best practices. With me today, I have Linas Suzius, who's the president of Advanced Underwriting Consultants. Advanced Underwriting Consultants has been a partner of Alpine for, I guess probably going on 10 years, helping our advisors and their clients with advanced planning techniques and information. So I'd like to bring Linas on as we get started today. Linas, are you there?
I am here, Dan. Thank you for having me with you here today.
Hey, Linas, how are you? Good to see you.
Great. Hope you are too.
I am doing fantastic. Thank you for asking. Well, before we get started with our stream today, I thought it would be appropriate for you to spend a minute or two to tell our advisors who are on a little bit about yourself and kind of what your specialty is at Advanced Underwriting Concepts.
Yeah, thank you for that, Dan. Yeah, it's hard for me to believe. I started in the life insurance business in 1987, a couple of years after graduating law school, and I was an advanced sales guy for many years, and then left that and was in private practice for a while, and got back into the advanced sales world. My company is Advanced Underwriting Consultants, and that's what we do. We answer advanced sales type questions, and we do it for marketing organizations for life insurance carriers, and we do it on an outsourced basis. So we get to hear a lot of the things that people like your listeners are doing, and help them remove the stumbling blocks in their cases, and that's what we do. There's very little that we haven't heard of before. Although I guess in our business, there's still the capacity to be surprised every now and then.
That's true. That's true. I say that change is the only thing that's constant in this business. I think it's important for our viewers out there to really understand Linas's relationship with Alpine Brokerage and you, the producer. What Linas has done for us and our producers is really be a coach and be a resource for our producers to talk to not only them about different topics that they may have questions on as it relates to advanced markets, but also if your client has a CPA or an attorney that's working on their trust or, some other center of influence, Linas has no problem working in partnership with you and Alpine and that individual to help provide a good solution for your clients. And I can't believe, usually I was joking, Linas, we see each other in February in the desert, but unfortunately, this past year that wasn't the case. So I'm glad that we can see you here virtually, and you've had a moment to jump on and answer some of the questions. So, if you don't mind, I think we should jump right in.
Sounds great.
Okay, good. Well, listen, I know that you and I have, as I said before, I've seen a lot of your presentations, and I know that there's one thing that you're passionate about. As it relates to planning and what you feel is the building block, one of the foundation blocks of a good review and financial plan with a client, and something that you are passionate about and talk about a lot. And I think that in 2021, it's never been more important to take advantage of this particular planning tool, and that is the beneficiary designation review. And so I thought we could kick it off by you, because that's really, as you've said, Linas, that's a timeless thing. It's not really timely. That's timeless, which it's been an important tool pre-pandemic and certainly will be post-pandemic as well. So if you could touch on that in the beginning to kind of get us kicked off here, I think that'd be a great starting point.
Yeah, I'm glad to, Dan. And yeah, I am passionate about it. It's not my only passion, but I am passionate about beneficiary review. So no matter what's going on in Washington, no matter how well or how much the federal government is trying to help us, our clients still need help with the beneficiary review. I mentioned earlier, as I was introducing myself, that I was in the private practice of law for a while, and I had a law firm here in the Franklin, Tennessee area, just south of Nashville. And one of the things we did was we did estate planning for our middle market, middle to high net worth clients. And typically, if we were putting together documents for them, we'd spend 5 or 6 hours visiting with them about what they had in mind for the distribution of their stuff in the event something happened. and we'd work really hard to get those documents right. And the reason I think that I'm passionate about the beneficiary designation on life insurance, on IRAs, on non-qualified annuities, is because those words, those beneficiary designations, are going to control the distribution of more liquid wealth for most of our clients than any document that an estate planning attorney would work on. You know, and I said I'd spend 5 or 6 hours working with clients on those documents. Certainly, financial professional, life insurance professional is probably not realistically going to spend that amount of time working on a beneficiary designation, but it does underscore that some time and care ought to be spent because of the amount of liquid wealth the beneficiary designation will control.
Yeah. And to that point, maybe you could give our viewers out there an example of some of the things that you have seen from a designation review that has been alarming or it has raised a red flag for you, or some of those things that you should be watching out for. Because I know just in my personal practice, I mean, you see all kinds of things. And I know from the advisor standpoint, you're at the house late at night, or you've spent 2 hours with the client and now they want to do the paperwork, or your assistant sent it over and you're in a rush to get it done. And maybe you get the primary designation, but after that, it may get a little cloudy, or maybe it's information that you need to follow back up on with the client. So if you could touch on some of those things that you see, I think that would be good pointers for our viewers out there.
Yeah, so it's a great point. And I've been at the point of sale when applications were being taken, and by that time, people have meeting fatigue, and it's hard to spend a lot of time on certain things. I recognize that, but it's still important. The biggest flaw that I see when when there's a beneficiary designation, and that I've seen, is that the estate is the beneficiary, and that might be primary. That's rarer. But estate as contingent is fairly common. You get the primary, it's easy to ask, could you want to get your stuff? But a lot of times the contingent is left blank. And we know that if there is no contingent named, for most carriers, that means that defaults to the insured's estate for a life insurance policy. Right. And what's wrong with that? Well, what's wrong with it is that if we've got a named beneficiary, they produce a death benefit and they get the money.
Correct.
Right? With the estate as beneficiary, the money's forced through the probate process in order to ultimately be distributed, hopefully, to the heirs. Now, why do I say that? Well, it's the probate process. You got to go hire a lawyer. You got to go through all of the probate process. Got to validate the will. You got to deal with the decedent's creditors, right? That's part of the probate process. If the decedent left creditors, they all get a crack at the decedent's stuff before anybody in the family gets it. If we've got a named beneficiary for life insurance, we bypass that whole process. But so the decedent's creditors getting a crack at the money, that's something that should be avoided. Right. Probate is structured, right? It takes about a year from start to finish, so family has to wait to get the money, and then it's public. Right. Mm-hmm. People can go down to the courthouse and find out your business, the decedent's business, by asking for the probate files. There are public records that are available. And so for all of those reasons, estate as beneficiary, from my perspective, is a mistake. And it's the thing that I see the most often. Again, not mostly in the primary beneficiary, but in the contingent. There's no contingent named estate as beneficiary. That's a missed opportunity.
Yeah, and I would add that when we look at these things, one of the number one benefits of most of the financial vehicles that we offer clients that have a beneficiary designation is that it bypasses probate for the beneficiaries. And if you fail to name a contingent, or even this may not be you, this may be a opportunity. We talk a lot in other presentations about building trust with clients. And the fact, even more importantly, with prospects. And if a prospect does not have a trust level with you, they're never going to move forward with any investment recommendations that you make. Right. So even on the front end coming in, if you do a beneficiary designation review and you uncover some of these things, you're going to look like a hero, number one. Number two, you're going to be doing the best thing for the client. And going back to bypassing probate, these assets, if it was you that did it, there's some gray area there where the beneficiaries could say, hey, you may have made a mistake there. And that could become problematic as well. Not for the person that you talked to that you had a great relationship with, because they're unfortunately gone. But now whoever the primary beneficiary was, or the children that weren't named contingent in that particular situation, it could be problematic. So I appreciate that. That's a great point. And I do think that is a timeless review point that many advanced planning individuals don't realize as well. So it's fantastic. So let's move forward. Go ahead. Yeah, please.
One more quick point. Beneficiary review for the reason you gave is great, right? And the main reason to want to do the review is not only to fix a state as beneficiary, but to pay attention to what may have changed in the client's life, right? The client may have gotten divorced, for example, and what could be worse than an ex-spouse being the beneficiary on a life insurance policy or other financial product? That's a problem, and it's a reason for you to be proactive in visiting with your clients, as you mentioned, on a regular basis to help serve them better.
Yeah, we laugh about this, but as I said before, the ex-spouse is probably not going to be bringing that up. That's for sure. So great. Well, I know that there's this term that's been out there in some of the media recently. It's a 3-letter word. In fact, it's all 3 the same letters. And that word is acronym is PPP. There's been a lot of talk about this. Now, I don't know what it is, but I'm joking. I'm being cute. But, I think it's important because PPP is such a big deal right now. It's in all the headlines and it affects so many business owners, which we're going to talk about in a second. I think it would be important for us to recap the PPP. At this point, most of our advisors, clients and business owners probably have, if they were eligible, gotten the first round of PPP. And if they've moved expeditiously, probably gotten the second round as well if they needed it or qualified for it. And so I think it's important for you to recap on that, Linas, and maybe talk a little bit about the forgiveness of that, because I know even personally going through the process, in 2021 with our businesses, a lot of questions are being asked from the banks and loans and things of, did you take PPP and how much? And those are, even though they are forgiven, they're still sitting on the balance sheet right now as a loan. So if you could give us a quick recap on that and maybe a couple of bullet points, I think that would be beneficial for our viewers.
Yeah, just quickly, Dan. So the PPP is Paycheck Protection Program, passed as part of the CARES Act. It was a way to lend money to closely held businesses. The first round was last year. You didn't even need to show a downturn in business. You just needed basically to say that you were worried about it and you'd be able to get money. And the money you were able to borrow from the Small Business Administration and administered through your local bank, the money you were able to borrow if you were a business owner was based on your payroll. Borrowing, sounds like, just putting something off until the next year. Well, the loan's forgivable if you met the parameters of the program. And so the first round, if you got money and you were a business owner and you used it for payroll, the loan amount that you used for payroll and other eligible expenses can be forgiven, and you get to keep the money. You don't have to pay it back. And so our business owner clients who borrowed money under the program last year are eligible potentially for loan forgiveness, but they got to remember to apply, right? It's like doing your taxes. You got to file the paperwork so that your local bank knows that you're eligible for forgiveness, and they can submit the paperwork to the Small Business Administration so the loan can in fact be forgiven and you don't have to pay it back. So that's something that, as we're meeting with our business owner clients, it's something we need to remind them of, need to ask them about, making sure that they're applying for PPP loan forgiveness. And then again, late in December, there was a new round of PPP that was approved by Congress and the president. It's available to businesses that had a downturn in business due to the pandemic, and it is also forgivable And so if you're working with businesses, perhaps hospitality industry-oriented businesses that have had a downturn due to COVID, you should remind them that they're eligible to apply for the new round of PPP, or perhaps apply the first time, again, through their local bank. It's the SBA, Small Business Administration Program, and that loan is also potentially forgivable if it's used for certain things.
Yeah.
So it's got nothing to do directly with life insurance, got nothing to do directly with what we sell. It's more about making sure that your clients are taken care of and doing what they're supposed to do.
Yeah, because if they go out of business, then obviously we don't have any clients to do any other planning with. Linus, I want to back up a second. We did have a question come in. It looks like Robin Edgar had a question on the review, and she wanted to know, if people do not have a trust set up and the minor kids and they want to go according to the will, what do you recommend?
Yeah, so there's about 4 different questions wrapped up in that. And so let me set up what I think is being asked. So you got a situation where you got, let's assume, single parent, 2 little kids. And the single parent wants to name the kids the beneficiaries, but has no trust created for the kids. And so the question is, how do you leave money to the kids? And what's implied in the question is correct. And that is that if you leave money and the little kids end up being entitled to money while they're little, it ends up being a court procedure to sort it out. Somebody has to raise their hand in the family and say, hey, I'm going to manage this money for the kids. And that process is more expensive and harder than perhaps it should be. So there are 2 ways to deal with that from my perspective. One way would be for the parent to create a trust inside of their will, testamentary trust, that is for the benefit of the little kids. And with the right kinds of words in a will, that can be done. It will be a trust that will spring into existence at the person's death. And you would name that trust as the beneficiary of the life insurance policy. So that way there's a smooth path to having that trust, that trustee of that trust, whoever's named in the document, receive the money and handle it on behalf of the kids. Now, that's not the same as naming the estate the beneficiary. What you're doing is you're actually naming that testamentary trust the beneficiary. And by doing that, you're bypassing the probate process. So that would be recommendation number 1. Recommendation number 2 is, and this is common, a lot of times our clients won't have estate planning documents where they've created testamentary trusts. And they're not going to go to a lawyer to buy term insurance from us, right? Because that doesn't seem reasonable from their perspective. And under those circumstances, what we can do, it's second best, but what we can do is we can use UTMA, Uniform Transfers to Minors Act, and use the right language from UTMA to make sure that somebody is named to handle and accept the money on behalf of the kids. And I'll give you a quick description of what the language needs to be. It would be name of adult custodian as custodian for name of child under the state, whatever state you're in, UTMA. Name of adult custodian as custodian for name of child under the state UTMA. That would be the second choice that works in the real world.
There you go. Delivering value right away. Appreciate that. Actually, we have one more on the beneficiary review, so we might as well knock it out here. Damian Deering, if a client is divorced and has a 1-year-old daughter, who should the beneficiary be if they want it to go to the daughter?
Yeah, it's the same answer.
That's an interesting one. Yeah.
Well, it's the same answer. Either the single parent creates a testamentary trust in their will, points the beneficiary designation to that testamentary trust, and it all hangs together, or the client uses the UTMA words that I just mentioned.
Gotcha.
To name an adult to hang on to the money for the little kid.
And just a quick plug here, this presentation and live stream will be recorded. So if you need to grab that language, you can always contact us at Alpine. We can help you with that, or you can catch this recording on YouTube as well. All right, Linus, let's shift gears a little bit. We did the recap of the PPP, which I think is important. As we said, no PPP, no clients, no financial planning. So it's a pretty simple equation as far as I'm concerned. And while we're in the vein of talking to business owner clients and about business owner clients, I know that there are some specific changes in 2021 and even back in 2020 that advisors should be potentially tabling with their business owner clients, looking at the different tax rates that are current. Obviously, we don't know what the future is going to hold with the new administration, but at least currently, what the tax rates look like and whether it may or may not be advantageous for a client to take advantage of some of the opportunities. So I think it would be good for you to talk about some of those changes and maybe what the opportunities are. You mind touching on that?
No, I don't mind at all. Thank you, Dan. So, a lot of our business owning clients, they've put together entities. And, over the past couple of decades, I would say most of our business owner clients have chosen to be taxed as pass-through entities. I'm talking about S corporation, LLC taxed as a partnership, sole proprietor. Those are all pass-through kind of entities where the owner of the company is going to pay income taxes on any company profit at their personal income tax rates. And traditionally, prior to 2017, the tax rates for individuals were close to the maximum corporate rates. And so it made some sense to be taxed as a pass-through entity. It didn't make much difference. There wasn't much to be saved by choosing to be a C corporation that was taxed independently of the business owner. But after the Tax Cut and Jobs Act in 2017, that changed. While individual rates and the top bracket did go down to 37% as part of the Tax Cut and Jobs Act of 2017, the top C corporation tax rate is now 21%, which is much less than the top personal rate. And so if you... Now,
Linas, I'm bad at math, okay?
Yep.
I just want to stop there to make sure everybody got this because, it takes me a few times. I'm bad at math, but I do know that 21 is lower than 37. I do know that. So, that's a big swing when you're talking about tax on profits, I would say, correct?
I think so. And, look, I'm not saying that everybody needs to change to a C corporation, right? There's a lot involved in becoming a C corporation or adding a C corporation to the mix of companies for an entrepreneur. No doubt about that. And there is some risk that tax laws are going to change in the future. No doubt about that. But Dan, as you point out, 16% is a lot. So if you've got a client making a lot more money in the client's business than the client needs to keep, they're a candidate to have a C corporation in their stable of companies. And, as you pointed out, that 16-point difference means real money. If you're able to keep an extra 16% of your profit and use it in your business, that's a very efficient thing to do. And
I think it's important too to point out, Linas, that there are some life insurance opportunities that are available inside of a C corporation that aren't available inside of an S corporation. S corp. Would you agree with that? And could you give us a little color around that?
Yeah, I sure will. From my perspective, it's efficient in a C corporation, more efficient to do deferred comp for non-owner employees, for example. Long-term care is more efficient in a C corporation. Certain kind of pension plans end up being more efficient in a C corporation. And so from my perspective, all of those reasons support the idea that you'd add a mix. One more reason, one non-tax reason, or indirect tax reason for you to be championing this idea with your clients who are making more money than they need to live on in their businesses. Their CPA is going to love the idea. Going to love the fact that you brought it up. Now, the CPA should be bringing this up to the client, but all of us who have met CPAs before understand that in general, CPAs are really good at recording history. They're less good at helping our clients predict the future. And while this is something a CPA ought to be bringing up, they're probably not. And so if you bring it up, you are the hero, and you're going to be the hero with the client's CPA, which is all to the good.
Yeah. I agree. I agree. You're educating the client and you're also educating the center of influence, which could ultimately lead to more clients because if you wow them with what you're bringing to the table, obviously they have other clients that are probably similar to the client that you had advised them on. So it's a great opportunity there. And as I said before, uh, if you do end up going down this road with the client, it does make sense to have a C corp. You can, if you end up saving them that tax, it's a way to redistribute some of that money that would normally be lost to taxes, maybe to do a deferred comp, maybe to do a key man policy that they weren't uh, ever going to do because they didn't have the cash flow to do on that key person. So I know a lot of our advisors out there like to bring ideas to their clients that save on taxes, whether that's from a real estate perspective or a financial planning perspective. So saving them on the taxes and finding them the money without them paying any additional than they were paying before, I think is a real win-win for the advisor, the client, and the center of influence. So that's great. Well, Linas, let's shift gears a little bit. I know we've been talking about the business owner, but let's talk about another topic that I think is very important, and that's our philanthropic clients, the clients that are looking to be more charitable with their wealth and give some of that away. They may do it on a regular basis, or they may just have an inkling to do something for a cause that maybe strikes a chord with them. So what opportunities do you have for our philanthropic clients, and what do you see as an opportunity given the estate tax threshold and gifting and all of those things kind of combined?
That's such a big question. Those on your those as part of your audience who've had charitable conversation with clients know that we end up talking about charitable ideas a lot more than we actually do them. But in any event, it's still worth talking about certain kinds of charitable things. Charitable remainder trusts still work. There's still a way for people to avoid capital gains tax treatment on the sale of an appreciated asset. Now, there are some downsides to charitable remainder trust planning too, and some of them are exacerbated in this interest rate environment. But if you've got a client who's motivated to avoid capital gains tax, it's still an idea worth talking about. In fact, I had a conversation with a producer just yesterday where that ended up being the path. The client is so adamant about avoiding capital gains tax that's the path the client is going to go down.
Now, do you typically find that on real estate investments or stock portfolios, or like what's the low hanging fruit for that type of concept?
Yeah, I don't know about low hanging fruit. Charitable planning ideas are hardly ever low hanging, with the exception of one thing I'll talk about later. But charitable remainder trust planning can involve appreciated closely held stock, appreciated publicly traded stock, appreciated real estate. All of them fit. The key element that you'll want to hear from your client is, first of all, they want to avoid capital gains taxes, sometimes at all costs.
Right.
And the second thing is, it sure helps if they've got some charitable intent, right? Because if either one of those is absent, it's a much harder conversation. It doesn't work that well. So
you're selling instead of solving an issue.
That's exactly right. In this interest rate environment, charitable lead trusts actually look better. It's a way for somebody to make a gift of an asset by siphoning off a lead income interest charity and leaving what's left to family. In this interest rate environment, that kind of thing can really has the potential to allow for a gift to family at a highly discounted rate. So that kind of thing makes a lot of sense to consider in this environment. You've got affluent client who is looking at estate tax management strategies, which we'll talk about more in a minute, I think.
Yes.
That's something to consider. The easy idea, though, is this one, and I think it's really overlooked. And from my perspective, if you're not talking about it, if somebody's not talking about it, they're missing a trick. If we've got a client who's 70 and a half or older and has an IRA balance, doing a qualified charitable distribution, a QCD, is something they ought to be considering. The law allows somebody who is 70 and a half or older to send up to $100,000 directly from their IRA to charity. And if they do that, it does two positive things for them. The first positive thing is that if they've got a minimum distribution obligation with regard to IRAs, that QCD amount will go towards satisfying their RMD. So that's the first positive thing. Even though they didn't take the money, they get credit for RMD. The second positive thing that they get is that the QCD, the amount sent to charity, won't hit the client's income taxes at all. So the client doesn't have to worry about itemizing. The client doesn't have to worry about AGI limits. None of that. What they send from their IRA to charity doesn't hit their income tax at all. It's easy to do. It's just paperwork. From my perspective, if you've got somebody who's 70 and a half or older and has an IRA balance, almost certainly they're giving money to some organization. Might be church, might be synagogue, might be American Heart Association, what have you, right? Some 501c3 charity. They're making some gift. They're leaving money on the table if they're not doing it from their IRA.
Yeah, for sure. I told you this earlier today that I actually have clients that they have around 4 million in IRA assets, 2 million in each IRA. And every year they do not want to take the RMD. And I actually made a note after we talked about this that when I see them in a few weeks, I'm going to ask them, hey, do you make any charitable? It's a question I have never asked them up until this point. They've been my client for about 8 years now. Sad to say that I've never said, hey, on your tax returns, do you make any charitable contributions? And now I am going to ask them, and it may be an idea I can bring to them. So I really do appreciate that. You touched on it earlier. I think it's an appropriate time to talk about that now. We're talking about charitable things and passing things on. So I think it's a good time to kind of touch on the estate tax situation, where we're at, because it has been a little fluid. I know we joked earlier that this is the highest exclusion amount that there has ever been, except for 1 year, and that's the year that the estate tax was repealed. Well, I think you said, Linas, right? 2010. Was that correct?
Yep.
2010. So if you died in 2010, you did all right. But if you lived after 2010, you did all right. So, in my mind, either way, you're kind of lucky. So, but why don't you touch on the estate tax, where we're at right now, what could potentially happen, and why it would be a good idea to talk to your clients, and why affluent clients, it would benefit them from taking advantage of what the rules are now.
Yeah, no, you're exactly right, Dan. So, $11.7 million exemption, federal estate tax exemption per person. That works out for a married couple to be $23.4 million for a married couple, even without them making any kind of special planning. The exemption amount for a married couple hasn't been that high, except for 2010 in recent memory. And so, that makes it, I suppose, a good year to die. We're not going to get much traction by encouraging our clients to pass away this year, but what we can do is we can encourage our wealthy clients who have estates that are worth more than married couples, more than $23.7 million.
Now, let me stop you there. If any of the advisors are on the call today and they have clients worth more than 23.7, it was, I think.
23.4, excuse me.
23.4, sorry. When you get up there, really, what's a couple $100,000 between friends? And, we need those people to call Alpine at 866-777-2006 right away after this call, please. And we definitely have some things to talk about. I'm digressing for a moment, but, I'm sorry to interrupt, but I couldn't help myself.
No, it makes perfect sense. I mean, you want to help those folks, right? Because they're worth helping, and you can do a lot of good. Yes. And that's the point. I mean, the exemption amount hasn't been that high in forever, except for 2010. And they're talking about reducing it perhaps to as low as $3.5 million per person. might work out to be $7 million for a married couple, which would put a whole new set of folks in line to have to pay federal estate taxes. And that's not even to mention any state nuances that might be collectible. If that becomes reality, and it's an if, right? It's not for sure, but they're talking about it.
Right.
If that becomes reality, more people will have to worry about estate taxes, and are people that have an estate tax problem today will have a much bigger problem, not only due to the lower exemption amount, but they're also talking about increasing the rate on taxable estates. So what can people do? What should they be thinking about? Well, the IRS has said some things about the current exemption amount that say you can potentially use it now and not get penalized. What am I talking about? Well, the estate tax exemption is tied to the gift tax exemption. So you can use the exemption either after you're dead, which most people do, or in whole or in part while you're alive. So you can make gifts of up to $11.7 million while you're alive, and you don't have to pay any gift taxes. It'll just reduce what's available when you're gone. And so for people who have high wealth, making sizable gifts now so that they can take advantage of the fact the exemption amount is high now seems like a prudent thing to do, especially since the IRS has seemed to say that they're not going to try to ding people who fully take advantage of the exemption today if it goes down later on.
Yes.
So
no clawback there. That's what it seems to be.
That's right. That's the word that's usually used for dinging people, is clawback on past gifts. So if it's kind of a use it or lose it time for people who have a problem, they ought to be thinking about it. People ought to be facilitating that discussion. Not saying all of them are going to do it, but they ought to be thinking about it.
Great. We have it looks like we have a QCD question coming in, another one from Robin. QCD is the best option, especially if people can no longer itemize due to higher standard deduction, right?
You're singing out of my hymnal.
He said, say that again?
I said, you're singing out of my hymnal. Yes, yes, indeed.
Yes. Okay. Well, there you go, Robin. Locked and loaded. All right. So we've talked about philanthropic. We've talked a little bit about the estate tax, where it is today, where it's going. I wanted to circle back on one topic that we didn't talk about when it comes to business owners, because most of our advisors that work with business owners, at some point we know that we're going to reach the end of the rainbow, and that business owner is going to exit out of that business, whether that be death or selling the business or passing that business on to their heirs. There is going to be some exit strategy at some point. So are there any tips that you can give our advisors that are listening to us today about business continuation, what that looks like, and some key items that we should be talking to with our business owner clients about that topic?
Well, from my perspective, it's the most fruitful conversation you can have with a business owner, right? I mean, it's the way you can help them the most, is by opening up that conversation. So having the conversation is more important than anything else that I think I'm going to say. And the conversation can start with, something as simple and provocative as what does it look like when you're done here? Asking the business owner that kind of question. What does done look like? And, there are all kinds of businesses. Ownership is done in all kinds of ways. Family may or may not be involved.
Right.
There may be minority owners, all of that. And so there is no one size fits all solution to business continuation planning, but it needs to be thought about and needs to be planned for so that it can happen in a way that puts the least amount of stress on the business and maximizes the chances for the business's success going forward. And most of our business owner clients really care about that. They really care about the business's continuity in the event something happens to them. And they also want to make sure that their family's taken care of, and that's part of the conversation. But from my perspective, that's there's nothing more valuable than starting that conversation. I would encourage you not to be afraid. If you need help while the conversation is going on, there are resources available to you, but start the conversation. That's really the way to serve your clients.
Yeah, and I think that's a great point, that we talked about before in some of our other presentations is just ask the question. And that's what we say here at Alpine, to our advisors. Hey, ask the questions that we give you. Just ask these questions. Bring us back the answers. And, we can see if there's an opportunity for you to better your business owner client's position, whether that's key man, whether that's buy sell, whether that's business continuation planning, whether it's a deferred comp for C corporations. Just ask some leading open-ended questions to your clients that we provide you. You don't have to be the expert. And Alpine Brokerage and our resources like Linas and people that we have access to are some of the best in the business, and we can walk you through step by step to provide you the solutions for your client. And if you run into a roadblock with the client's COI, maybe their CPA or their attorney, or they had an insurance person, that's really where we can step in and be your subject matter experts as it relates to these types of planning topics, and really help to bring those cases across the finish line. So it's a great testament to us and our partnership. I can't believe that we have known each other over 10 years now. Seems like yesterday. We were just young men when that happened. But I really appreciate your time today, Linas. And go ahead. You have something you want to add?
Yeah. Can I make one more quick point on that?
Please.
The part you want to start the conversation with your business owner clients, and part of your role is to be the accountability partner. To be the one who challenges the client when the client tries to tell you something that's not going to work. Give you a quick example. I mentioned I had an estate planning practice here in the Nashville, Tennessee area. One meeting I had was with a construction owner client and his wife, right? 100% owner of a construction company and his wife. And we were doing estate planning documents. I think we were doing revocable trust documents. And one of the questions I asked of the business owner client was, what is your plan in the event something happens to you with regard to the business? And what he told me is that, well, something happens to me, my wife will be able to run the business, will be able to continue it, and will continue to provide a good living for her after I'm gone. Well, I stole a look at the wife when he was giving that answer, and she was surprised and apprehensive because in her imagination that wasn't the plan, right? It wasn't that she was trying to kill off her husband or anything like that. She had other ideas, in the unlikely event that happened, what was going to happen with her. And so, I was able to be a bit of the accountability partner there, use the wife's expressions, and we were able to have a more honest discussion about what a realistic plan might be for the continuation of the business in the event something happened to him. That's what can yield fruit for you.
I'm sure you could classify that look as mortified, probably would be the best way to describe it. Well, I really want to thank you for your time today, Linas. And I know that you're a very busy person helping a lot of advisors out there, but I do appreciate your partnership with Alpine Brokerage. I wanted to point out that you do, what is it, a monthly video that's on your YouTube? And if you just Google, why don't you give yourself the plug, please.
No, thanks, Dan. I appreciate it. Yeah, so we do a free webinar, generally advanced sales related stuff, the first Wednesday of every month at 11 o'clock Central Time. If you've got an interest in signing up for it, it's free and available to anybody who wants to come. Get word back through Dan. You can send word to me if you've got my contact information. We'll get you on the list. We'll make sure that, there you go. Ask the expert at advancedunderwriting.com. If you email us, we'll get you on the list for the free webinar and make sure you get an invite every time we do one.
Awesome. Thank you for that. And just to point out, you can always reach out to Alpine Brokerage and we can get you set up with a call with Linas and his team. And we ask them about a lot of different things, and they have always given us some great solutions. We're working on some high net worth individuals right now that have had some very distinct planning needs, and we've been able to provide the agent the words to say in order to bring these clients to the point where they are interested in talking more about these concepts. So I think it's been a great time that we've spent today. I want to thank all of our viewers out there. You can always get a hold of us at 1-866-777-2006. Touch base with your account executive. Visit our website at www.alpinebrokerage.com and view any of these videos that we've done here on our YouTube channel. Just go ahead and Google on the YouTube there, Alpine Brokerage, and we'll pop right up and give us a like there. So thank you very much today. Appreciate it. Appreciate all the questions and the feedback from our field and our partners. Linas, do you have any final words?
No, thank you. Thank you again for allowing me to be part of your meeting today, Dan.
All right, great. Well, have a great day, everyone. Really appreciate it. And we'll see you at the next edition of the Alpine Broadcasting Network. Have a great day.